In this video, we're diving into a topic called stagflation. We'll cover what it is, its origins, and how it affects your investments. Let's get started. So, what is stagflation? Stagflation is a tricky economic condition. It's a combination of high unemployment and slow economic growth, defined by a period of negative growth in a country's GDP. Stagflation might seem improbable because unemployment and inflation usually move in opposite directions. Typically, high unemployment means lower prices and vice versa. So, how does stagflation happen? Let's break it down. First, let's understand inflation. Inflation is when your currency loses purchasing power, meaning your dollar buys less than before. Inflation occurs when money supply grows faster than economic growth, creating a supply shortage and driving prices up. Now, a little inflation is considered normal. For instance, the US Federal Reserve targets a 2% inflation rate. But when inflation exceeds this target, the central bank raises interest rates, making loans and mortgages more expensive for consumers and businesses alike. The term stagflation combines stagnation and inflation. It gained widespread use in the US during the 1970s, a decade marked by rising inflation and high unemployment, leading to two recessions. Now, what creates this? Stagflation occurs when rising prices coincide with low economic output. This often starts with higher energy costs and is then shifted by government policies that regulate labor, markets, and production. This results in fewer products on the market and lower consumer demand, leading to business layoffs and a continued economic downturn. Stagflation impacts both personal finance and investments. If your salary increases outpaced by inflation, then your real earnings start to drop. Similarly, inflation erodes the total return on investments. For instance, if your investment grows by 5%, but inflation is 8%, then your actual gain ends up being negative 3%. Stagflation also creates economic uncertainty. As consumers worry about job security, they then reduce spending to save more, which further slows down economic growth. Since consumer spending drives the economy, less spending means a tougher road to recovery. In summary, stagflation is a challenging economic condition that can significantly impact your investments and personal finance. By understanding its causes and effects, you can better navigate these tough times. If you found this video helpful, don't forget to check out MarketBeat's other resources on economic trends and investment strategies. Thanks for watching and happy investing.